Philip Stoten. Welcome to our new show, EMS and the Economist. Each month, we're going to be talking to an economist. One of our three economists on the team is Shawn Dubravac, who is the chief economist of IPC, among other roles. Shawn, good to talk to you. How are you?
Wonderful, wonderful. Good to see you.
Good to see you. I guess everybody's been asking you over the weekend what's been happening with Silicon Valley Bank and what does that mean to the tech sector and the EMS and the manufacturing industry. What have you been telling them?
Certainly, Silicon Valley Bank and its moves there last week have been the big news. It was a very large bank, 16th largest in the country, so definitely a big bank. It's we haven't seen a bank closed for a couple of years now, and for the most part, those were small. So this is the biggest bank that we've seen close since the financial crisis. I suppose the good news is there that we saw a lot of banks close during the financial crisis. So we had a playbook. Headed into the weekend, I expected the FDIC and the Fed and Treasury to all work together over the weekend to make sure that there was good clarity by Sunday evening. We've kind of seen this before. Silicon Valley Bank is interesting because so many people see the exposure to Silicon Valley and to tech companies, and so there was a lot of concern that there would be really strong contagion within the innovation sectors of the economy. But it looks like depositors will be made whole and have access to all of their account information and their account holdings. So payrolls will be met, and it should slow any any run on any other banks. But when there is uncertainty or when there's fear in the market, then at times market participants will act irrationally. So that that could still be the fallout here. We might see some irrational moves, moving forward, but it should settle, and the impact, the broader, wider impact, should be relatively muted. Not to suggest that there won't be some things some fallout that we see, but it should be relatively muted because of the moves over the weekend.
Yeah, I think that's really important. I think Thursday, Friday, I was seeing some comments about whether some Silicon Valley companies would be able to meet payroll this week because of access to funds. And if that's been shored up, that'll make a lot of difference. Obviously, there's concern for contagion elsewhere. And I think it is the second biggest bank ever to fail. The largest was obviously in the financial crisis in '08. So yeah, some impact there. But it's kind of curious. We seem to be constantly getting mixed signals from the economy, but particularly from Silicon Valley. We had these large numbers of redundancies, and Meta have talked about this year being the year of efficiency, and maybe another round of redundancies coming along. But we see that on the back of huge growth in employment last year and a growth in jobs added in the general economy in February. How do you view those mixed signals around employment as opposed to the economy?
We're definitely getting mixed signals, and we're in a transition period. We're moving to a slower period of growth, and much of that is being orchestrated by the Federal Reserve, which is tightening financial conditions, and so we have some weird things that happen as part of that transition. It's not an even transition. Here in the U.S., manufacturing saw the first decline in job growth in February that it had seen since April of 2021. So we've been adding manufacturing jobs. We've been adding jobs in electronics manufacturing. Despite the concern that the economy was slowing, the labor market looks very strong. And prior to everything that happened with Silicon Valley Bank, my expectation was that the Fed would remain diligent in their efforts to bring down inflation. And obviously some of that, inflation is going to be driven by strong job growth, by workers demanding higher salaries because there's a tight labor market. So you're looking to slow the growth in the labor market a little bit, and you can do that by slowing the growth in the broader economy. At the same time, we are, despite this slowdown, I mentioned, slowdown in manufacturing jobs in February, we're at really good levels. We're at levels that we haven't seen in decades in some cases. And that's true across a number of manufacturing sectors. So if you look at electronics, for example, we're getting back to where we were during the financial crisis. We've regained the jobs that we lost over the last decade. And those job losses came on the back of pretty significant declines in 2001 when we hit a recession, and 2007 and 2008 when we hit a recession. So this is the first recession in a very long time that we added workers. Now, we're not fully through this recession. We probably haven't made it all the way through what will be a transitionary period. So we'll see where manufacturers net out, but we're seeing a pretty strong underlying economy, and you even see it in my forecast. You see it in other forecasts from economists, that we keep anticipating this period of slow growth, but we keep pushing it out just a little bit further. For forecasts for whether it's Europe, US, China. We've seen economic forecasts improve somewhat for this year, not great improvement, but you have added a few tenths of % of growth to this year in Europe and the US, and so things are looking a little better, despite the fact that we know we're in this period of slowing growth.
Yeah, it's curious, isn't it? I mean, the Fed seemed to be quite resilient and quite determined in terms of rate hikes. We're seeing other places around the world follow suit in that. So those are pushing in that direction. I spoke at a conference last week in Munich, and I think the underlying thought there was that most EMSs felt they were going to have some low single-digit growth this year. They weren't expecting to their overall market to shrink. So it's very confusing. And again, on the salary side, there's definitely pressure on salaries to increase. And we've seen, specifically in Mexico, for example, a big hike in the minimum wage, and that's certainly filtering through the electronics industry. And there's definitely a talent shortage there, and there's a risk that could slow down some of the reshoring that we've been talking about for some.
Yeah, well, and I think, to me, it's interesting that when you talk to the EMS companies, they're still expecting growth this year. Given the environment, that's a pretty optimistic perspective. And I worry at times that there could be some downside risk to those expectations. I think what buoys my hopes for the EMS industry in 2023 is that the sectors that are doing quite well are sectors that we service quite well. Aerospace, defense, even automotive is coming back, so we should see growth relative to 2022. Historically, at least in the US, the auto sector won't be as strong as it has been in the past. We're not back to 2019 levels, but we'll see growth from 2022 levels. So all of those sectors that continue to do well should help buoy the EMS industry. But we do see slowing demand for durable goods. We do see slowing demand for the goods economy overall, and that it is a headwind certainly for the EMS industry. So
I think what's curious there is a lot of that consumer electronics, if you like, is not the mainstay of most of the US and European EMS companies. It's many of that 6 out of the top 10 companies that are headquartered in Taiwan are dominant in that sector. So perhaps it's there that it's going to have the most impact. What I'm really interested in from a EMS point of view, particularly as we look at this regular communication with economists and the relationship to the EMS, is what do you think are the key indicators they should be looking at on a regular basis as they look to that they look to plan their business. Obviously, interest rates are important to them. That's having a big cash impact. When I look at their internal KPIs, I really encourage everybody to think very much about the amount of inventory they've got and the work in progress and how they can shift the huge amount of cash that's been sucked into that area back out. But what do you see as their important economic KPIs?
Yeah, and I think we can kind of break it into two buckets. I think we can look at the economic variables. I think we can also look at the industry variables. Obviously, IPC publishes a host of industry related variables that I think are pretty important for EMS in companies to look at on a monthly basis. So we publish book to bill figures, and obviously I think those are good to just benchmark against your own book to bill numbers and see what the broader industry is doing. For North America, the EMS book to bill still looks quite strong. So order flow still looks pretty good. When you look at PCB, we are starting to see that slow. So we're starting to see that, at 1 or slightly below. So order flow is slowing. At the same time, all of this is happening. Obviously, some of the transition in the electronics industry was that we were able to get shipments out a little bit better. And so that also helped improve the book to bill. Every month, IPC publishes a sentiment report, which I think is a great view on what your peers are thinking and how they're seeing the world. And it gives you a read on optimism within the industry. And so that's just another tool to kind of gut check your own expectations. Am I being overly optimistic? Am I being overly bearish? I can give you a feel. And certainly we can identify turning points in that. So I think that's another great industry report. On the economic front, you mentioned some of the financial variables. I think those are important. It's key that EMS companies have a good working relationship with their financial institution, given everything that transpired at the end of last week, and also importantly how quickly it transpired over really about 48 hours. Obviously, it had been building, but it is worth just having a conversation with your bank. Many companies are going to have that conversation with their bank, especially if you're working with a regional bank, and just doing a little bit of due diligence. Now, I don't think depositors are the ones who are going to really hold their banks accountable. It will be stockholders and bondholders and others, but using those as a metric, is your regional bank that you might be running payroll through, and that you may be running cash receivables and cash payables through, just check on their well-being. If the stock is down significantly today, then that's the market telling you that they might not be as viable as you had hoped, and it might be worth developing a relationship with another bank, maybe a big national bank, or maybe just another strong regional bank in your area. So certainly let the market tell you the viability of your bank. Just because you don't want, even if the FDIC insures your account, presuming you're holding under 250 grand in account, and there are also tools that will help manage that to make sure that you are sweeping cash into a variety of accounts and spreading that out so it's all FDIC insured. You just don't want to deal with the technical headache of having to receive or make payments like payroll. So checking on that. In the real economy, outside of the financial economy, I think it's things like durable goods, especially looking at the sectors that that I'd already mentioned. If it's a sector that you have strong exposure to, aerospace, defense, then I would certainly be looking at the broader indicators for those sectors.
Yeah. What about internal indicators? I mentioned KPIs like how much cash you've got tied up in work in progress and inventory. And I think inventory overhang at a time like this where stock has been bought at very high prices is a concern. What do you think about having those internal indicators internal KPIs that you should really be perhaps a little bit more laser focused on this year than you were on last year when inventories were building up.
Yeah, I mean, I love the idea of dashboards and every company has their dashboard with their key variables that they're watching. You know, maybe they've got a financial dashboard, they've got a production dashboard, they've got an economic dashboard. So they're going through these on a pretty regular basis, maybe not daily, but certainly keeping an eye on them on a weekly basis. So when you think about inventory in this environment, I do think that the inventory shortages that we saw in 2022 and 2021 are not over yet, but we are, quickly working towards the end of that. And with slower demand, you will want to carry lower inventory. You're going to, have to hold that inventory over a longer period of time if you're facing slower demand. And so I do think that you are going to see companies broadly within our industry and with other industries slow their inventory and in other cases kind of accumulate inventory back. There's sectors of the economy that still have very low inventories. One example is automotive. That broadly that sector is under inventoried. It will build it back. It probably won't get back to 2019 levels. Normally in kind of pre-pandemic levels, we were holding about 2.5 months of new vehicles in inventory relative to sales. We're down to about a half a month right now. I think we come up from there, but I don't think we get back to that 2.5 months. So, inventory to sales ratios, look at where you were in 2019, look at where you were in 2021. Chances are you're probably going to find something, in between there, lower than you were in 2019, but higher certainly than you were last year. And then, just be cautious. And I think it's worth making sure that you're able to get the inventory that you need. One of the reasons we had companies wanting to hold on to some of this inventory was because it was hard to come by.
Yeah.
And, now that it's getting easier to come by, there's less reason for you to have financial resources locked up in that inventory.
Yeah, it's fascinating, isn't it, Shawn? It's that swing of the pendulum from just in case to just in time that we've seen substantially move over the last couple of years, and it's finding that point that we're now comfortable at, and it's not just the EMS that has to consider that. It's the ODM and looking at, maybe having some inventory consigned at the EMS that you actually take ownership of, that gives you that additional security if you're in an industry where you need to maintain critical shipments, but you're not sure how smooth the stuff coming in the other side is going to be. Shawn, we're going to be talking every 3 months as part of this series. You're one of my three team of economists. I'm excited to be doing that. So if you were asked to give your predictions for between now and when we speak again in 3 months, where do you see the major shifts in the economy? I know it's a tough crystal ball question, but I'll be watching it back and checking it out in 3 months' time.
Yeah, so I think we expect an orderly decline and a slow, a broad slowdown that will be felt in, different parts of your business. Then, highlighted with these just massive sparks of uncertainty. Silicon Valley is an example, but it isn't the only example, and it isn't the only one. And it will happen in different ways. And this is what tends to happen during downturns: is that you have these environments that are not well managed, or at risk of failure, but a good economy kind of covers that up, and then in a bad economy, those weaknesses and those danger areas are really exposed, right? And so we're going to have this orderly slowdown. I think we're going to just kind of have this grinding economic data over the next couple of months. We're in this period where we think growth is going to be slow in the first half. So we're expecting GDP to be negative these first 2 quarters. we're expecting to see kind of this continuous slow decline. We expect unemployment gains to slow down from where they are. The first couple of months were pretty good. We expect to see things slow down from there, and but then we're going to have these sparks that are going to just shock us. So you have to expect those, but you don't know where to expect them, right? That's uncertainty.
I think that uncertainty is really interesting. And, I've talked a lot in the last 18 months about design for disruption, not just in terms of product, but in terms of your business and your business strategy. Yeah. And I think one economist put it really simply is that if you list the top 10 disruptions, there's going to be one outside of that in the next quarter that we just didn't expect, and we've got to be ready for the ones we expect, but we've got to be ready for these outliers. And Silicon Valley Bank was one of those, and who knows what the next one will be. But
and they end up being adjacent to you, right? They may not even directly impact you, but this is the contagion that happens naturally in a downturn and in a recession, is that there's some spark, it ignites a fire, there's an explosion next to you, you think you're isolated, you think you're not impacted, and then you find out, I am impacted by that, and we're impacted by it indirectly. And so it will be these just sudden bursts of uncertainty that will make your customers uneasy, will make you uneasy, and then part of it is going to be a runaround. Something will happen, and then you have to go figure out, do we have exposure to this? How impactful is this to our business? Are our customers feeling this? So, those are all the questions to ask when you see these unexpected surprises. Is, well, first and foremost, what's our exposure? But then quickly, a second is, how are our customers dealing with this? How are they going to be impacted by this?
Yeah, and suppliers and everybody else in the supply chain. Shawn, what I would say is thank you so much for providing that prompt and regular data. It's more valuable now than it's ever been. As you said, I think these things are exposed much more in a softening market than they are when the market's ramping up. So I think it's even more important that people watch them. Thanks so much for your time, and look forward to chatting again in a few months' time.
I can't wait.